Hello, and welcome to the Behavioral Health and Wealth channel. Today's video is going to be focusing on Stock Talk Basics. And remember, if you do like this video, please click like and subscribe to the channel for future videos on behavioral health and wealth topics. So before we get started, simple disclaimer, I am not a financial advisor or a tax consultant. Always make sure that you do additional research to make sure that you are always comfortable with the decisions before investing real money. So the topics we'll cover today are what are stocks and shares, some basic stock common terminology, differences between an investor, swing trader, day trader, how to select the appropriate broker or platform to trade, brief definition of paper trading, how much money do you need to actually start trading, and what you should buy, and how to review historical trends of companies before making your first investment. And then we'll go a little bit into actually how to buy and sell. So the first thing is, what are stocks or shares? So at the basic definition, a stock is also known as a capital stock of a corporation in which shares into ownership of a corporation is divided. In simplest terms, these shares are known as stocks. A single share of these stocks represent a fractional ownership in a corporation in proportion to the total number of shares available by that particular company. In essence, if you purchase a stock or share of a company, yeah, you are part owner of that company. Although small, you still have ownership, and in many cases, will have the ability to vote on things that shareholders would have a voice in. So very important. A share is the smallest unit of which an ownership of any company and represents the proportion of ownership in the company. Some of the top gauges of the economy, and you've probably heard these terms before: S&P 500, the Dow Jones, and the Nasdaq. So starting with the S&P 500, this is made up of 500 different large companies or large cap companies that are listed in the Standard and Poor Index, which is a popular stock market index that follows price and performance of those 500 companies. The Dow Industrial Jones average, this is one of the most watched indicators worldwide. These are made up typically of the 30 large companies or blue chip companies that are tracked as indicators of the overall market's health. And then we have the NASDAQ. The NASDAQ is an American stock exchange. It's the second largest marketplace in the world in terms of market cap. And again, these three items are important to watch. They tend to have an influence on the overall market and could also have a significant impact on any individual company stocks that you may own. So some common terminologies, that you'll hear whenever you're getting into investing or purchasing stocks. Starting off with the bull market. This is a terminology when the stock market or the economy is an upward trend. Typically, it's viewed by an uptick in prices. Sometimes it might be multiple sectors at a time, sometimes individuals. But going back to the definition of the S&P 500 and the Dow Jones, typically when all of those markets are in an upwards trend, it's considered a bull market, where there's money being dumped into the economy. People are taking the opportunity to purchase more shares. The upward trend, bull market. Naturally, the bear market is the opposite, which is typically indicated by a downward trend, or a period of falling stock prices, typically over a longer period of time, several months of continued downtrend performance. A blue chip stock. These are large industry leading companies that have significant dividend payments and have a reputation of sound physical management. A bid. A bid is the amount of money a trader is willing to pay per share for a given stock. It's a balance against the ask price, which is what the seller wants to pay per share of that same stock. And the spread is the difference between those two prices. A sector is a group of stocks that are in the same industry that belong in the same sector. An example would be a technology sector, which would include companies like Apple and or Microsoft. A stock symbol. A stock symbol is typically made up of 1 to 4 characters um, with an alphabetic root symbol that represents the publicly traded company on the stock exchange. For example, Apple stock or Apple's company is known as AAPL, while Walmart is known as WMT as the stock symbol or ticker symbol. Volatility, this is the price movements of a stock. Um, Typically, when a company is considered highly volatile, it means that the price fluctuation has the ability to go up or down very quickly in a short period of time. And the sell-off. So a sell-off occurs when a large volume of shares are sold in a short period of time. Sometimes the causes of sell-offs could be disappointing earnings. There could be of fear of increased competition, and sometimes it could be related to natural disasters or political news that may cause sell-offs. Now, definition between investor, swing trader, and day trader. An investor is any person or entity who commits capital with the expectation of receiving financial returns through long-term strategic positions. Um, in my opinion, an investor is in it for the long game. So you're not really concerned about the up and down fluctuation. Typically, if you have a 401k, a Roth IRA, you're putting money away for the future and are willing to ride the fluctuation in prices. A swing trader, on the other hand, this is someone who is more into the speculative trading and where you may be in it for some short term gains, and short term can last anywhere from uh, several days up to just a few months. So the swing trader is purposely trying to take the opportunity of a low discounted price and selling it at a somewhat of a higher price and moving on to the next trade. A day trader is the practice of buying and selling within the same day, typically before the close of the market. This tends to be very highly volatile. A lot of research definitely needs to go with being a day trader, as price fluctuations can cause you to make a lot of money quickly, but it could also put you in a position to lose a lot of money quickly if you're not prepared to um, sell your positions at an appropriate risk factor that you should have set in advance. Now, before you can start trading or purchasing shares, you do have to select a platform or broker. A broker is an individual or firm that acts as the company between the investor and the security exchange or the company. So before you can actually purchase a share of Walmart, for example, you must have a broker or platform in which you can make the purchase through. Some examples of some common brokers or platforms are E-Trade, TD Ameritrade, Charles Schwab, Robinhood, Webull, Fidelity. There's many more brokers and platforms out there. As always, make sure that you do your research before selecting a broker, as certain trades may come with commission or trade fees that could impact your profit. Um, Before you start trading, you could always look into paper trading. Some of these brokers offer a paper trading platform, which is a simulated trade that allows, as a new investor, ability to practice with fake money, digital money that's not tied to your real funds. Gives you the ability to practice buying and trading using the real market values. However, fake money that isn't, again, tied to real funds that you would have had to deposit. This is a great opportunity for those of you that are just getting started to test out your skills before really investing your hard-earned money. So one of the questions I typically hear is, how much money do you need to get started? So the answer to that, it depends on what company stock you are considering purchasing. So for example, if you just wanted to purchase, a few shares of Nike, well, depending on the rate, the average price that Nike might be going for on the day that you're wanting to purchase, let's just say $100. Well, at a minimum, you would have to have at least that $100 plus any possible commission fee or trade fees that your broker charges you. But the ratio typically would be the price that you're willing to pay, and the going price of the actual share is how much money you would need to purchase. So of course, the more shares, you would multiply the ask price compared to how many shares you're looking to purchase, which is the price per share. So the price per share will be the price at a minimum you would need. And then the broker fees, again, depending on your broker, may charge you a purchase commission fee that you would have to add on top of the price per share. And then assume losses over profits. So one of the things I tell new traders is never use money that you cannot afford to lose. Similar to going to Las Vegas and gambling, you should be prepared to, if you lost all of that, it wouldn't put you in any significant financial debt. So assume losses over profits, and you will be much more clear-headed when it comes to taking risks. One of the things that when I first started to trade is trying to come up with funds that were funds that I didn't need in my day-to-day. And sometimes you have to find those extra funds through either side job hustles or, perfect example here is taking advantage of money back credit cards to earn extra money towards investing. So one of the examples of things that I do is I have a main credit card that offers cashback bonus money on everyday purchases that I would make anyway. So I use that credit card as a means to make my everyday purchases. And at the end of the month, based on my spendings, I will take that credit or that cash back and I will reinvest that into my portfolio. And again, that's just one of the ways that you can earn extra money with spending that you would normally do on a regular basis. Now, another question. Typically, again, I hear this in new traders when they have money, now they want to buy, and the first question is, well, what should I buy? My advice would always be, do not ask anyone what you should buy, and don't buy just because someone else recommends something. And always do your research and due diligence. Have a plan on getting in and getting out. What's the price point you want to pay, and what price point would you want to sell at if things go south? So always make sure that you're comfortable and have that game plan before you start investing. And before you actually purchase, I always feel like it's important to review the company's historical performance. Researching a company's stock performance typically over the last 3 to 5 years gives you an idea of the company's trend and whether or not, if you're in it from the long for the long term, whether or not the company is going in the right direction that you can see profits in the next few years if you continue to be a long-term investor. Some things to think about when reviewing a company is, will the company be around in the next 5 years? Are they a company that is using technology and taking advantage of the technology out there to adjust to consumers? Has the stock price increased or decreased in the last few years? So again, using a 3 to 5 year historical performance view, are they trending up or are they trending down? Is the company being innovative? Are they a leader in its industry? So are they new to the market with any new tools that's creating the buzz or creating revenue? Or are they someone that's living in the past, right? So perfect example would be, yeah, if you remember when Blockbuster Video was out, they did not adopt new technology, and therefore eventually were closed down because they didn't fall into using technology. Before you know it, companies like Redbox and then the streaming services eventually crushed the video retail sector. And then the last thing is, are you a consumer of the company? Now, being a consumer of a company doesn't mean that you have to only invest in companies that you're a consumer product of. However, if you are a consumer of a company, you tend to follow the trends. You tend to follow what the company is doing, and hopefully that makes you feel more comfortable in making your purchase. Now, when you're ready to buy and sell, a couple of keywords. Once you've signed up with the broker and ready to buy your first share, familiarize yourself with some of these terms. Again, these are just a few terms. There are many more. So again, do your research. But when you're ready to make a purchase using Nike, for example, the market order is a purchase price at the exact time that you execute the order. So if I'm getting ready to make a purchase at 9:30 a.m. and the price of Nike happens to be $100 at the price I hit execute, or at the time I hit execute, I will purchase one share at $100. Now, between the time that I hit submit and the time that I looked at the price, if it fluctuates by a few cents, if it fluctuates by a dollar, whatever the price point is captured at the time that your purchase execute is what you're locked in. If you're looking at purchasing Nike more for a long term, then the price difference of a few cents may not be a big factor to you. However, if you're a day trader or a swing trader where you're planning on selling within a day or the next few days, then a matter of a few cents, depending on how large your purchase is, may be very critical in your profit or loss. The limit order is an exact price you're willing to pay, or buy or sell. So again, using Nike as a perfect example, if you're only wanting to pay $99 per share, even though the price is at currently the market price is at 100, your limit order will not execute until the price of Nike drops to $99 exactly before the broker will execute your order. This is always my preferred method because I always like to ensure that the price I'm wanting to pay or sell is the price that I would enter in manually, and not rely on the fluctuation that could adjust in the matter of seconds. A stop order is when a share price drops to a fixed stop price. It triggers a market buy or sell. Again, the market buy or sell price has a lot of volatility and can swing in a matter of seconds, which is why the last option here of a stop limit order, again, this is when a price drops to a fixed stop price. It triggers a limit buy or sell. And again, limit is the specific price that you entered. And last, I just like to show this is the Thinkorswim platform. Just wanted to show an example of Visa. So whenever you're doing an historical trend, and again, this information can be found even with just simple Google searches of the company that you're looking for. But this Visa example shows you over the course of this time period that they're in a nice upward trend. And here you'll notice they had a downward trend, a little bit of a sell off, and then it started to pick back up. So before purchasing, your own shares of a company, take a look at, their history. Is it a company that's continuing to generate revenue? Are they continuing to increase their price per share? And again, take a look at what the company's forward thinking, a forward view is, and if you believe in that company being around for the next 3, 5, 10 years. Another example here is Walmart. Again, Walmart having a low of $73 at one period, having a natural up fluctuation over the last few years. Again, stable company, has some price fluctuation. If you're a long-term investor, these ups and downs may not really matter to you. Um, Always consider some down drops as opportunity to add more to your position. But again, always do your own research, know what you're getting into, feel comfortable with your entry points, feel comfortable with your exit point. If if prices start to go below a certain amount and it's beyond your risk factor, just know when to exit. All right, that concludes today's video. Thank you for watching, and please subscribe to this channel for future videos on our behavioral health and wealth.